So the workshop for tonight is basically our Southern Indiana homebuyer workshop. Talking about how to buy a home with, as a first-time home buyer, whether it's with no money down, with a VA loan, whatever, different programs that are available out there. We're going to go through those this evening. We're also going to talk about different payment options that are available. So kind of in comparison with, how much a rent payment is in comparison to how much a house payment is for different levels of price. So we're going to talk about those things this evening as well. So I'm going to cover a number of different things tonight, but I did want to go ahead and kind of introduce myself and also Doug. So this is Doug Dillon. Doug's been in the mortgage business for about, 17, 18 years, something like that. And we work together. So Doug does a lot of marketing for us. He's kind of like a customer care specialist, transaction coordinator. He just wears a lot of different hats, so he does a lot with us. I'm Nathan Soliday, so I've been in the business since 2002 full time. In Southern Indiana, we've helped probably over 1,300 people or clients over the past 16 or 17 years buy a home. So we've done a lot of loans in the past, and continue to enjoy the business and continue working through helping clients and that type of thing. So a couple things as far as experience here. Basically, we're a direct lender, so we're not a mortgage broker, but we actually lend our own money and that type of thing. So whenever we do a loan, we're actually lending that money from our corporate office. We have several different low down payment programs and even no down payment programs that work well, whether you're a renter or whether you live with family or whatever the case may be. Several different options there, and we work really hard to get our clients into a home. So if somebody doesn't qualify now, we try our best to try to get somebody a game plan within the first 30 or next 30 to 90 days to be able to help get you guys into a house. So anyway, so that's just a little bit about us. Kind of go through just a few pictures of homes that we financed, in the last couple months here. Year to date, we're at about 102 homes that we've helped finance throughout Southern Indiana. We also do Kentucky, so we do both states. But we do all types of different homes. We'll talk about that tonight as far as the different home types that we do, whether it's a stick-built home, manufactured home, different types that way. So we're going to look at those this evening and kind of talk about that. But the main things I want to talk about tonight are the 5 pillars of buying a house. So basically we're going to talk about those. There's so many details about the home buying process. It can be overwhelming, but we're not going to cover all those tonight. We're going to keep it simple and keep it down to 5 things. So the first one we're going to talk about is credit. So credit, a lot of times when you think about buying a house, the main thing that everybody talks about is what's my credit score? How do I determine what credit score is needed to be able to buy, and that type of thing. So we're going to talk about that a little bit. We're going to talk about income. So we're going to kind of talk about how much money you need to earn and be able to buy a house or to qualify for a home. So we're going to talk about that and also where that income can come from. We're going to talk about debt and how important debt is to the calculation of being able to qualify and to get pre-approved for a house. So we're going to talk about that a little bit. Also talk about down payment. So the big things that everybody always likes to talk about is credit, obviously, and down payment. How much money am I going to need to be able to get into a home? So we're going to cover that this evening as well. And then lastly, we're going to talk about property and property type and what kind of properties can actually qualify for a loan, what kind of properties can qualify for FHA or USDA or whatever the loan type is. We're going to discuss some of those tonight. But we're going to keep all that into about a 30-minute time span. Just kind of keep it condensed for this evening, but just kind of get the basics of what you need to buy a house and the basics of the 5 pillars of buying a home. So we'll just start with credit. A big thing we always talk about is the credit scores. What kind of credit score do I need to qualify? You'll hear a number of different things out there. You'll hear that a difference between us compared to a bank is we're a little more flexible in what we allow. Some banks have some really tight guidelines. As far as what we offer, we're a lot more flexible in things that can kind of work for the loans that we have. So I don't know if you guys can see in the back here, but minimum credit score for each different type of loan we've kind of got laid out here. So the FHA loan, it's the most flexible program that there is, and we can go down to a 580 credit score with that program in some cases. And it's not every case, but if somebody has some good assets, if you have a good 401k, or if you had some decent savings in the bank, we can go down that low. But we can also go anywhere in that range. So 580 up to the top credit score that you have can be a good option for FHA. On USDA, we can go down to a 600 credit score. So you'll see a lot of places today will do the USDA program. They'll only go down to a 640 credit score, and that's really common. So if you go to your local bank, you may see that, or if you talk to the loan officer there, they may say, hey, USDA does not go down under a 640, but they actually will. They'll go down to a lower credit score, and we can actually underwrite the file down to a 600 on USDA. So it's something to keep in mind. And we'll talk about USDA in just a little bit what the down payment is on that program, but it's the most popular program that we're doing right now. VA, so is anybody a veteran in here? So no veterans here, but VA is a great program. We can go down to a 580 credit score on VA. And the nice thing about VA is it's a no money down program, and there's no mortgage insurance on VA. So it's a really great option for a veteran. And we do quite a few of those, especially just kind of in our area with Fort Knox too far away, and that type thing. Indiana Housing is a program that we've just added recently, and it's a really neat program. So basically it's an FHA loan, but it has a grant for the down payment. So it's very rare in Southern Indiana that there's any lenders offering this program. The nice thing is that grant, if you live in the home for 2 years, it's forgivable. So if you buy a house for $200,000, the grant would be $7,000, but it's forgivable after that 2-year span. So you actually kind of, in theory, get $7,000 in free money when you buy a house. So that's pretty neat. But the credit score requirement is a 640. So it's not as flexible as some of the other programs, but it's because you get the grant, for that. So it's really, really nice. And Indiana Housing's been around for a long time. Just not a lot of lenders that offer that program. But we have that, so it's pretty cool. And then the last one we've got here is a conventional loan. We can usually go down to a 620 credit score on conventional. Kind of depends on the mortgage insurance and that type of thing. It's the most strict of any of the loans here. So even though they'll do a 620, it may not actually approve you with the 620. You may still have to have a higher credit score for that. Now, other things from a credit standpoint, it's not all just about your credit score. There's other factors that play into it. So if somebody's had a bankruptcy, depending on which program we're looking at, the shortest time that you can buy a house if you've had a bankruptcy in your past is 2 years. So it has to be 2 years from the discharge date of when that Chapter 7 bankruptcy was discharged. If you've had a foreclosure in your past, then we can actually do those too, but you have to wait 3 years for that. So sometimes people get discouraged and they think, okay, I've had a bankruptcy, I've had a foreclosure, there's no way I can buy a house. But it's not true. There's actually just a little, short waiting periods on those, and it kind of opens up some different options for you. Now on those, it kind of depends on the program. For example, FHA is the 2-year bankruptcy, waiting period. Same on the foreclosure. USDA has a little different timeline, VA, so they all kind of have a different option on that, but it's something that we look at, on an individual basis. So, any questions on those so far? That you can think of? Anything that you're not sure about? Anything you want to add?
No, we're good right now. Yeah.
So, from a credit standpoint, now there's other factors that play into it. Those are the main things that we look at, especially when we're doing a pre-qualification. Now, other things we're going to look at is basically different trade lines that a borrower has, like how many payments you've made, different installment loans or credit cards. Auto loans and that type of thing. We look at all those together, but that's the main things on a credit report that we look at. Secondly, on income is very important, obviously. When we're thinking about income, it can come from a number of different areas. So, obviously if you have a regular W-2 job, full-time position, we can use that. But also if you're self-employed, we can use that income too. So from a self-employment standpoint, we need to see a history of 2 years on your tax returns just to be able to get a good idea of how much income that you've made over that timeline. That's something that we look for. Like I say, on the W-2 employee, 2-year work history on that, it does not have to be at the same job. So a lot of times we'll get that question of, I've worked here, but then I switched jobs 6 months ago. That's okay to switch jobs. As long as you don't have a big job gap or anything like that, it's okay to have that situation. Along with that, we get a lot of younger borrowers too that are just coming out of college or just finishing up college or even high school. Depending on the situation, if a person has went to college and is still just graduated, or it kind of breaks into that 2-year history, that combination can be a combination of work and also school. So we have to show those transcripts, but basically a combination of those two things. Fixed income is okay, so we can do disability or Social Security income on basically any of these programs, as long as it's enough to qualify. So it's got to be enough income on there to be able to cover not only the new house payment, but also to cover the actual debts that a person has. So for example, if the Social Security income is $700 or $800 a month, it's probably not going to work. But if you get up a little over $1,000, then you've got a good chance, unless there's just a big, car payment or car loan, that you have or something like that comes up. Now, one thing that we have that's kind of nice, especially, it's basically just on the FHA loan, but if your income's not enough to qualify, you can actually add a non-occupying co-borrower to that. So basically, it's a co-signer, like we always hear about if you're buying a car, somebody that can co-sign for you on the house, and they do not have to live in the home. So it's really nice. So if you had a parent that wanted to help you out, they can actually co-sign for you as a co-borrower on the loan. But they do have to basically qualify with their income and their debts, along with the new house that you're buying, to be able to help out. So their income has to be enough to help there. But it is possible, and we do several of those. It's a nice, flexible program. FHA has that option to be able to do that. So anyway, that's the main things on the income part. Debt ratio kind of falls right in line with income. So obviously, when you talk about how much money you make and how much of a home you can afford, debt ratio is where that comes into. And it's kind of a fancy word or fancy term for this calculation right here. It's basically your monthly debt divided by your gross monthly income. So if you're trying to figure out about how much you can qualify for a house, you basically start with this calculation right here. So for example, if your you can say your auto and personal loans add up to $500, but you make $2,000 a month. Right off the top, your debt ratio would be 25%. But then we also added a new house payment to that. So whatever your new house payment is, we add that to it, and then that would get you up into the actual total debt ratio that you have for buying a house. And whenever we look at that, part of our pre-qualification that we run all the numbers. You don't have to know these numbers, for yourself, but it kind of gives you an idea of what we do and how that works. But what we do on that, we actually do the calculation, we work it out, and we can go up in some cases to 41% all the way up to 55.9% for a debt ratio. So basically that means with FHA that your debts can be half of your gross income and still qualify. So FHA is really flexible on what they allow for that debt part, debt portion of the pre-qualification. So it's pretty nice. But you can also kind of do that in your head too. And the main things that we look at on the debt, we don't look at utility bills, things like that. Home, as far as auto insurance, those things are not calculated in your debt ratio. But what is included is your car loans, personal loans, credit cards, student loans, child support if that's paid, etc. So things like that are included in a debt ratio, but the other items are not. So basically anything that's going to show in your credit report, that's what we're going to use, as far as those debts. So any questions on those? Anything you want to add to that, Ben? On the debt side?
No, I think that covers most of it.
The nice thing is with FHA being able to have that flexibility up to the 55%, that allows you to buy a little more of a house than you could at the normal 41 or 45% that a lot of other lenders require. If you've got an extra 10 or 15% on what your payment can be, that allows you to go up another $30,000 to $50,000 on a house that you may not be able to get elsewhere. So it gives a lot more flexibility as far as what you can qualify for.
And on existing student loans, Nathan, is the rule 1% of what the balance is?
Mm-hmm. Correct. So if you've got student loans, they're going to use, if you're not making payments right now on that, if they're deferred, then they're going to use 1% of your balance. So if you have a $10,000 student loan or a total in student loans, then they'll use $100 from a calculation standpoint. It doesn't necessarily mean that's the payment that you're making right now, but they do use that number in the overall calculation. So it's kind of like having a $100 personal loan, monthly payment on that. So anything else? Okay. So let's talk about down payment a little bit. So down payment's always the biggest. It can be the biggest hang up for somebody when they're buying a house. It can slow people down, and that's oftentimes what kind of keeps people renting for the rest of their lives. So it's always something that kind of holds them back. But the problem is most people still feel like they have to have 20% down to buy a house. And that's a big amount of money. If you think about buying a $100,000 house, that would be $20,000 out of pocket that a lot of people think they have to be able to buy. But, and we think about a $200,000 house, and again, that's $40,000 down. And it is nice if you have that money to put down because that keeps your payment lower and it keeps your mortgage insurance lower, but it's not realistic for everybody. So that's a nice thing to have some different options with different programs that are out there. So I mentioned USDA earlier. USDA is the most popular program that we do. It's basically no money down. You do have closing costs and things like that that you either have to pay or that the seller, you can negotiate with the seller to pay. But from an actual down payment standpoint, it's zero down or 100% financing as far as what you see. It's a great program, especially for Harrison County, for Crawford County, Washington. Most of the counties around, until you start to get into New Albany or close to it, and then kind of that area doesn't qualify. But USDA, it kind of has different boundaries as far as areas that does qualify and does not. But still, for this area, it's a perfect program to do. And with us being able to go down to 600 credit score, that's been able to open that up to a lot more buyers that are out there. VA, obviously, we mentioned that earlier. It's a zero down program. We don't have any veterans in here, but again, it's no money down. Fantastic option. Indiana Housing, since they do the grant, the 3.5% grant, it's still no money down. So they basically finance that down payment in with that second mortgage, and it works out well. FHA is the most flexible program that we have. That's the one that will go down to a 580 credit score, the one that has the 2-year bankruptcy, the 3-year foreclosure timeline. But it does require a little bit of a down payment. So 3.5% is what it requires. And with that, so if you think about that, $100,000 loan would be $3,500 out of pocket that you would have for your down payment. But again, it's the most flexible. So they require just a little bit of money, but if you've got, some credit that's a little dinged up and that type of thing, it's still a good option to go with.
Excuse me, Nate.
Yeah.
And also with an FHA, I think they would agree that you can have what's called gift funds.
Mm-hmm. Yep. So
To
that's
help you with your down payment.
Yep, and the gift funds, I'll get to that in just a second.
Okay.
It's a great option too. We'll get to that in just a
Okay.
moment. On a conventional loan, we can do 3% down, up to 5% down. You can do more than that, but it's from a minimum standpoint. The conventional 3% is a great option. It does have some income limits, but it's a good option to have. And then 5% down. But on the conventional loan, you want to have a little higher credit scores on that program. 640 or better typically. But that's part of what we do as far as kind of walking you through what you can qualify for and what the best option is for you. So again, the USDA and FHA are the most popular. And I didn't get to the gift program, Colin, so you're right. So yeah, on the gift side of things, if you're doing the FHA loan, you can actually get a gift from a family member. So if you've got a parent that doesn't necessarily want to co-sign for you, but they want to gift you the down payment, that's perfectly acceptable and a great way to go. And it gets you back in. So even though you may have a low credit score, so you may not qualify for the USDA, you can still get a gift from a family member or a grandparent, to do that. And again, it gets you in with the no money down option. So it works out well.
I was going to also say that on the FHA, as far as a gift, the other way that a lot of our clients do it is doing a 401k. If they have a 401k, they can actually get what they call a hardship loan, but it's down payment assistance from your 401k, which they give you a loan, and then you can use that. There's no penalties or anything like that. So a lot of people do that as well.
Yeah, but that's a lot of people don't realize that they can access that 401k. So it's there, and they see money coming out of their paycheck every week. They don't think about that they can use it for a house, and the hardship option is a good option. You can also do a loan on that money where you don't actually get penalized or anything like that, and you're paying yourself back for the down payment. So it's a good option too on the.
Are you going to mention also in your negotiations with your real estate agent?
As far as the
For the
seller
seller.
paying some cost,
Is
yeah.
that on there?
So that's part of it too, as far as your down payment and just kind of working in your closing costs with your offer, because the down payment is separate from your closing costs. So closing cost has different things like your appraisal, your title fees, lender fees, setting up your escrow account, but all that can be negotiated in with your offer whenever you go to write that up. So. All right, so the last of the 5 pillars I wanted to mention is the property. So sometimes the property, when you think about property type, it can be a little confusing on what is available out there as far as from a financing standpoint. The easiest house that can be done is basically a stick-built home. So it's just a regular frame-style house. We always refer to it as a stick-built house, but that's the easiest one. And that qualifies for every program that we've mentioned so far. That's the most common, property type, obviously. We can do manufactured homes. It has to be a double wide. It cannot be a single wide. But we do the manufactured homes on the FHA program. We also do it on the VA program. And that's the main two. The other options that are out there will not work for a manufactured home. So sometimes if somebody's looking for a house, that will limit you in what you can do if you decide on a manufactured home. The nice thing is with the manufactured homes is a lot of times you can get more house for less money. So that's what makes it more popular to be able to finance those. But when you're looking at a manufactured home, if you're not a veteran, then that means you're going to have a down payment. So basically, you're going to be looking at 3.5% down payment on that if you find a house that's a manufactured. So, and that's pretty well across the board. I don't know of anybody that's doing a zero down manufactured home loan, but FHA is the most popular program that's done on. So, must be move-in ready. So a lot of times, I know a lot of first-time home buyers are looking at homes that they can get cheap and move into and kind of fix up along the way. And that's a great idea, but if it's got too many repairs or a lot of issues with the home itself, then that's not going to work with most of the programs that I've got that we've went through so far tonight. Basically, it needs to be move-in ready. If it needs new carpet, that's fine. If it needs some basic things, but if it's got holes in the wall or it's got a roof that leaks, if it's got several different issues like that, then that's going to hold you up from being able to do it. One of the first-time buyer properties or programs. There is options out there like a 203K and different things like that. But if you're really looking to get into your first house, sometimes that may not be the best option for you. So we usually recommend it be to be move-in ready, something that's not going to overwhelm you, especially on a first home, to be able to get in and be ready to move right in. But as I mentioned, these programs do not allow the single wides, does not allow a full fixer-upper on these. Any kind of farm or large acreage, it does not work. So usually we can go up to 25 acres, but most of our programs want to be less than that. And then burn homes we don't do. So there are lenders that will do a burn home. We just don't offer
Right, what a burn home is.
that program.
To let them know.
Yes, you want to explain a burn home?
Yeah, so burn home's the one that's in the ground, you got 3 sides in the ground and the front. So it's just considered a specialty home, and we don't do those. So.
Yeah. What did you guys say a common rent payment is, at least in Harrison County? What's a good average?
$750, $800.
Or something nice.
Yeah, so right around that for something decent.
Every once in a while you'll find a $600 or $650.
Not very often.
Yeah, exactly. So this kind of tells you what what you could actually qualify for or have from a payment standpoint. So I'm just using the USDA program as an example, but a $70,000 house, $406 a month plus taxes and insurance. So taxes and insurance are basically your property taxes and then your homeowner's insurance. So obviously, just like your car, you have to have insurance on the property at all times. Any lender is going to require that. But what we do, we add in the taxes and insurance with that payment. Monthly mortgage insurance is separate from your homeowner's insurance, and basically it's just a fee that's charged each month by USDA that kind of keeps them in business and keeps that program going, the way it works. But the nice thing with USDA, it's a reduced mortgage insurance amount. It's not actually called that, but it still basically serves the same purpose. But that kind of gives you an idea. So for example, $406 a month, if your taxes were $50 a month and your insurance was $75, basically you just add $125 to this amount, which would give you $531 as far as on a payment for a $70,000 house, which is pretty good when you compare to a $750 rent, on that. Now it's tough to find a $70,000 house that's kind of meets the criteria of what we've talked about, like as far as it being move-in ready, stick build and that type of thing. But it is doable, if you keep your eyes open and find that. But that's kind of what you'd be looking at on a $70,000. On an $85,000 house, you can see there's not a lot of difference there. So basically, difference between $70,000 and $85,000 is basically the difference between $493 and $406. So $87 more a month, you can move up in house by about $15,000 on that. Again, you still have to add the taxes and insurance in, but that gives you an idea of what your payment would be there. And then for $100,000, you can go up to about $580 is where that would put you at. So $580 per month plus taxes and insurance. So when you add that in, that's going to put you right around $725 to $750, just like with rent, average in this area. So $100,000 house can equal what you can rent for, a decent place around in the area. And then I just kind of bumped it up a little further. So $150,000 would put you about $869 plus taxes and insurance. That's going to put you just a little over $1,000, probably $1,050 on your payment. Just because taxes are going to be a little higher on that price range of house. So insurance and taxes will be a little more than what it would be up here as far as that total. And then one other one, $200,000, $1,159 per month plus taxes and insurance. So by the time it's all said and done, $200,000 house probably going to cost you around $1,325 or so a month for that. But like I said, that would buy a lot of house, in Harrison County and in Crawford, Washington, and that type of thing. And then I've just got those estimated on an annual percentage rate of 5.425 over 30 years. And those are 30-year payments on there. So We do 15-year, we do 20, 10, 25, but the most common is a 30-year just because that gives you a little lower payment, you know, for the actual range that you're buying in. Any questions on payment, on different payment options or anything like that? Okay. All right, so basically the conclusion of what we're kind of talking about tonight is this. It isn't as difficult to buy a house as you might think. You know, you can see that there's a lot of flexibility on credit scores. There's a lot of flexibility on down payment. It's just a matter of kind of your comfort level as far as the monthly payment, you know, and things along those lines. But we do the best that we can to make it easy for you to be able to buy. And the way the programs are set up right now, they're a lot more flexible than they were, you know, 7 or 8 years ago, you know, right after the housing crash of 2008. So things have loosened up a lot. But the biggest thing or the biggest takeaway I want everybody to kind of take away tonight is basically you do not have to have 20% down to buy a house. You can buy with no money down in a lot of cases. So anyway, so that's basically all I have for this evening. But I wanted to mention if this workshop was helpful for you, please help us kind of spread the word. You know, share our information with anybody that you know that's thinking about buying a house. We'd love to help them and you know, be able to help them in the near future. But I want to kind of open up for any questions, kind of general questions right now, if anybody, you know, thinks of anything.
I was just going to add to it, we don't just, we will take you through every loan process and every part of it, and we're actually a partner with you guys as far as going through it. You'll not be out of the loop at any point, and so you'll know every bit of the process, which I feel that we kind of pride ourselves on that. You know, everybody in the realtors, the buyers, the sellers, everybody knows exactly what's going on in the, you know, as the process goes on, which is a strong point for us.
Yeah, definitely. Timelines, for example, on most of these programs, we can get them done in 30 days or less. So the nice thing is, if you find a home, you know, before Thanksgiving, it's possible to have you moving in before Christmas. So that's a really neat thing too. So, you know, depending on you know, what your timeline is, that's a good thing. And what we'll be finishing up with tonight is basically a credit review. So I think you guys filled out a form, and what we'll do is you know, basically take a look at credit, review that, try to do a pre-qualification for you this evening, and then if it looks like something we can do, then we get some information, you know, some more information to finish out a full pre-approval, and then hopefully get you house shopping from there. So that's kind of the game plan with that. So anything else we need to add before we kind of get started on that? Anything you think of? Tom, anything else?
I'm good.
Yes, sir.
Thank you. Good job.
All right, good deal. Well, we'll finish that up, and then we'll work on those, and anything you guys can think of at the moment. Okay, all right, well, thank you guys.